Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, and my guest is Rob Morrison, co-founder, managing partner and co-head of property at Barwon Investment Partners. Welcome, Rob.
Thanks, James.
Rob, Barwon was really one of the early movers into the alternative assets space in Australia. So can you give us the background to the establishment of the firm and why you chose the asset classes that you did?
Well, thanks, James. Well, Barwon was formed in 2006, so Sam Armstrong and myself formed the company. And we both had institutional backgrounds, long histories in investments. Sam was private equity, my background was property and property securities. And we felt there was a real opportunity to form a firm that focused on private equity and property, but particularly looked at those opportunities that were between those two sectors that were less researched, less competed, where there's real opportunities for good investing, and also opportunities where there's really good tailwinds behind the markets. And we felt there was lots of institutional investors out there and also wholesale investors that were missing out on those opportunities because, quite frankly, the opportunities were either smaller or more niche than what they've been looking at in the past. So we thought there was a real opportunity there, and so Barwon was formed. And because both Sam and I came from the Geelong area, that's where the Barwon name came from, and over the last 16 years we've built the firm brick upon brick, got through the GFC quite well, learned a few lessons, and from that we've been able to build our client base, and now we're a team of 40 staff. We've got about $2 billion under management, and I'm very active in three key areas.
Alternative asset classes are playing an increasingly important role in diversified portfolios these days. Do you find that clients are seeking that diversification first and foremost, or is the search for yield a more important driver of Barwon's business?
Well, I think it's both. A lot of our investors are seeing the importance of having exposures to real estate private debt, private equity, and particularly healthcare property at the moment as being really important diversifiers for their portfolio. So certainly that's what they're after. But it is true, with low inflation, low interest rates, the search for yield is still strong. Has been a theme for many years now, but it's still there today. And luckily the areas we focus on generally have high yields. So healthcare property is yielding 5.5% or thereabouts. Our real estate private debt is typically yielding anywhere between 7% and 8%. So those kind of attributes, and also with lower risk attributes to that yield, that's pretty interesting for many investors. And so if you can get a tick in the diversification box and a tick in the yield box, then that's a pretty good combination.
Will that search for yield and duration be the same huge factor over, say, the next decade as it has been over the past decade?
Yeah, you would think that with interest rates now, probably at the tail end of the tightening phase, that people will be starting to rotate back towards growth, and I think we have seen a bit of that happening. But when you think about the ageing population, when you think about the fact that many seniors in our community are somewhat asset rich but income poor, I think the search for yield is going to continue. Even if interest rates push up a little bit, I still think yield is going to be a pretty important theme. So I'd be saying to many investors, don't tip into growth only, have diversification, and yield, cash in hand can be quite handy.
Barwon's demonstrated a persistent ability to capture a private market premium. So what's the secret to that?
Well, it is true that if you're working in illiquid markets, private markets, over the longer term, you would expect a bit of a premium over listed markets, and I think the theory supports that. So, how do we capture that? Well, part of it is being early movers, so doing your research well, having boots on the ground, and targeting markets which are less competed, less well researched, and have got some mispricing. So we look for those, and so if you look at Barwon's portfolio at the moment, no surprise, healthcare, real estate, clearly an area which is emerging, but we were pretty early there. Real estate private debt, similar theme. In our listed private equity area, we were investing globally into listed private equity, which is not a mainstream area, but we think again, has a good premium. And more recently, the launch of our disability accommodation fund, another example where we're entering a market early, we've done our research, we've got our boots on the ground, and we'll look for those premiums by being very careful where we invest, but making sure that we're in there and being nimble and looking for those really good opportunities.
You've shown a willingness in some of your funds to provide liquid access to traditionally illiquid asset classes. So What are the dangers inherent in that, and how do you manage them?
Well, it's very true that you've got to be very careful when you're offering liquidity when you've got asset classes that are generally illiquid. So our philosophy is, one, to be very transparent about the liquidity processes, and two, try and match as best you can the liquidity you're offering to the fundamental attributes of the asset class you're operating in. So for example, in direct property, we make sure that our liquidity opportunities are every 5 years, which is kind of sensible when you're investing in direct property, when you've got transaction costs, you've got stamp duty, and it takes time to kind of build through that. A 5-yearly liquidity cycle is about right, we think, for real estate. In our listed private equity area, because we're investing into listed stocks, on US stock markets, European stock markets, we can offer daily liquidity because we've got listed security as the underlying assets. So I think the lesson there, and I think you raise a really important point, you've got to be transparent in the liquidity processes, and they've got to match the features of the underlying assets.
And as you pointed out, there's some asset classes in which investors shouldn't be expecting liquidity to be instant, because that deteriorates or is detrimental to what they should be trying to do with that asset class.
Yeah, there's been some history over the last 20 years in Australia where we've seen, particularly in real estate, for example, some managers offering, liquidity profiles that don't match the underlying assets. And, they might get away with it for a while when markets are good, but when the markets, turn south and there's challenges, that mismatch gets found out very quickly, and it can be quite painful for investors. So, I'd like to think that nowadays, credible fund managers, understand that, they've thought it through, and are offering products that are really fit for purpose. And I think we've come a long way.
But isn't there a bit of a trade-off there in terms of potentially, in some areas, giving up and the illiquidity premium that's there if you actually want liquidity?
Yeah, I think you've got to be clear about what you want. If you want liquidity, invest into products that offer liquidity with liquid assets underneath them, and don't pretend that you can get liquidity when the assets underneath are not suited to that. So I think do your homework, ask the questions if you're an investor about that match, and pick better quality, well-respected managers.
What kind of investors represent the bulk of your client base?
Well, Barwon started off very much focused on institutional managers. So some of Australia's larger and well-known pension funds, super funds are our clients. That's been a great start for Barwon. But in the last 5 years, we've become far more active in the wealth management sector. So some of the better quality wealth managers around the country are our clients, and also family offices and wholesale investors generally. So that's the makeup. Probably about 70% of Barwon's funds under management is institutional, but we're certainly very active in the wealth management sector.
Are there any plans to open up your funds to retail investors?
Well, we've done just that. So our listed private equity fund, which offers investors exposure to the global listed private equity market, so KKR, Blackstone, 3i, these types of groups are in our portfolio, and we've recently launched a retail version of that fund. It's been going now for about 12 months, getting really good response, and perhaps not surprising, the performance has been very strong. I mentioned to you earlier that the performance of that fund has been 51% for the last 12 months. Over 10 years, it's done 14%. So we're very proud of that track record, and it goes to the fact that we are investing into private equity markets. So you expect strong performance, probably a bit higher volatility, but the performance over the long term has been strong. So we're really pleased to be able to offer that to retail investors.
What are some of the most common misconceptions you encounter around the place about alternatives and your sectors in particular?
Well, I think some people see alternatives as being rather complex. Maybe the fees are a bit higher, and maybe it's hard to access. So we've tried to address that by making sure that our products are pretty straightforward. We're investing into healthcare real estate. It's pretty clear where we're going. The way we structure those investments is very, very straightforward. Real estate private debt, the same. We focus on first mortgage investments, good quality counterparties, good quality properties. Again, a pretty simple proposition. And with listed private equity, well, it's a global strategy, global equity markets. Again, pretty straightforward. So we're not into options or future structures and some of the more kind of exotic kind of structures that some alternatives offer. At Barwon, it's very transparent, and we like to keep it simple and do it well.
When Barwon assesses investments, what in your view is the thing or the attribute that actually creates the value?
For us, it's been, I think there's four contributors. One is do your research and do it early and look for those markets which they're mispriced, less competed, and importantly have strong tailwinds. So that's kind of the first point. The second is we want to be nimble and move fast, because if you're going to capture that alpha, you're going to capture that kind of premium, then you need to be able to kind of grab those assets quickly and in front of your competitors. So at Barwon, we do our due diligence, and if need be, we can have an investment committee meeting within 2 hours to approve an asset if we need to do that. And so that gives us that nimbleness to be able to capture assets. I think the third thing is partnering. Like we'd like to find assets, hopefully, that are off market. So rather than going through auction processes and competitive processes, if we can find an asset, particularly in healthcare or even in real estate private debt that's off market, where we can do it through partnering, that gives us an edge, and we like to do that. And then finally, it's about having the team. You've got to have a really experienced, qualified team with repeatable processes that are well honed, and being able to price risk. And I think, as a general comment, funds management is about pricing risk well, and if you can do that well and do it quickly in a repeatable way, then you're likely to be able to grab that alpha, and I'd like to think that's Barwon's history.
How do you create value in a low interest rate, low cap rate world?
Well, one thing we don't do is try and forecast cap rates. We can't control cap rates, so we need to focus elsewhere. And so what we focus on is income. So, is the investment likely to be able to produce, recurrent, repeatable income? And that comes down to the quality of the tenants or the quality of the counterparties. That's a big focus for us. A second area is adding value through asset management, and certainly in the real estate area. And I think, all of us own properties, or many of us do. You can't be a passive owner of real estate. You've got to be an active owner. So you've got to be able to add value through leasing, through refurbishing, through repositioning your assets, working with your tenants. So we really pride ourselves on being able to do that, and so we've got a big asset management team at Barwon, and that's all I do, day in, day out, is trying to add value to assets. So I think they're important attributes of adding value, and I think the other one is getting your timing right. Entering early if you can, and exiting when you see some strong pricing. Don't try and get the last 2 cents. Exit, and your investors will thank you for that.
For most of Barwon's existence, interest rates, bond rates, spreads and cap rates, they've all ground steadily lower. How do you think the portfolio will look as these mean revert, if they actually do?
Yes, well, look, like many fund managers in Australia, we've been debating when is that mean reversion going to happen. Surely it's going to happen sometime, and we haven't seen it yet. And I think, looking at the inflation outlook, at the interest rate outlook, we may well see some further cap rate compression from here. I think that's quite likely in the healthcare sector. So we think there's a little bit to go yet, but our philosophy is that you focus on good quality assets, and so we're focusing on better quality healthcare assets, better quality first mortgage loans, better quality counterparties, because we want to make sure that when the tide goes out, as inevitably it will one day, we want to make sure that our assets are going to stand up to that kind of rigour and that shake, when it happens. And we think those that are chasing higher yields, lesser quality assets, will find they're going tough in that environment. So our focus is on quality, and we're prepared to pay to get that quality.
The latest fund, the Disability Housing Fund, is that a logical move simply given the base in healthcare real estate, or is it a shift to a more impact investment style?
Well, it's a bit of both. We've had a very good run with the healthcare real estate area. We've been involved with it now for 7 years. We're an early entrant there, and we've made over 50 investments in the healthcare sector across Australia. And we've got about 1.2 billion under management at the moment. And I suppose what we've learnt along the way there is that the healthcare sector is resilient, and part of that resilience is from the quality of the tenants, but also by the fact that the government is actually behind much of the healthcare sector and supporting that part of the community. So, turning now to disability accommodation, we think that is also a sector that's got good tailwinds, it's got government support, and the demand for fit-for-purpose accommodation for people with disabilities is large, and is going to continue on for 10, 20 years. So, we see a really good opportunity there to kind of enter the disability accommodation sector quite early, as we did with healthcare, use many of the same skills that we've got in healthcare to apply to the disability sector, and we think we're going to do a lot of good investing there. But the nice thing about both sectors is the fact that we're investing well, but we're also doing good in the community. And I've got to say, it's a real motivator for our team, and I think for our investors as well, that Barwon is active in healthcare, in mental health, in cancer care facilities across Australia, and here we are now kind of turning our attention to another really important sector, being the disability sector. And so yes, it's an investment strategy, but it is also an ESG strategy. And we think if you invest well and you do it with a good social conscience, then that's a double win, and that's our approach.
It's great triangulation in that the clients, the ultimate end clients, get probably better housing than they would have got that's purpose-built.
Yep.
The government has a significant issue taken off its hands and given to people who know how to do that better. And the professional investment techniques come along and generate a good return for the investors. So it's funded better, the product's better, it just works better than standard government will build it.
That's very true, and I think you've got to give credit where credit's due. I think the NDIS has been a great initiative, and it's been well thought through. Now it'll evolve and it'll be refined over time, but I think the government's done a really good job in kind of setting this up. And you're right. I think the private sector is better placed to be able to deliver this kind of facility across the country. There's a huge need for it, but it's got to be done well to the right standards because we're dealing with people with disabilities, and it's got to be done with great care and attention. And so we're very, very focused on that. But yeah, good opportunities, and if we can invest well and build some terrific facilities for people with disabilities, across Australia, then what a great thing that'll be.
What has been the impact of COVID, Rob, on the kinds of healthcare property that you own? Because I'd imagine a lot of the services that your healthcare portfolio hosts, as in the operating businesses who are your tenants, a lot of those services were probably put on hold during COVID, and are they banked up?
Well, it was interesting. Last March, April, when things were locking down, particularly in Victoria and across Australia, many hospitals had to, largely close down or certainly take staff off, and there was a big concern at that time as to what would happen. Now, the federal government declared that the healthcare sector was essential services, and the federal government then kind of backed the rent payments needed by those private hospitals, and so they continued on pretty well. But what we found is that for March, April, even May, some doctors, some medical facilities were concerned about their businesses and they were asking for some rental assistance. But it was interesting, by about May, June, July, all of a sudden the sector started coming back to life quite quickly. Rents were being paid, and in the end we ended up collecting 98.5% of all of our accrued rents, so 98.5%. Now that's a very different scenario to office or retail, which had some very big issues, and many of them are still having issues. So what we found was it was a huge bounce back, and a lot of the elective surgeries were put on hold, then started again, and even today there's a huge bank up of elective surgeries right across Australia. And so, for example, our Gosford Private Hospital in New South Wales, it's operating at about 120% of its capacity. So it's operating at night, on weekends, to try and catch up on this huge workload. And when those big high acuity hospitals get into full flight, then it affects the whole ecosystem of the medical sector. So your GPs, your scanners, your pathology units, all of those groups are then having to work hard to kind of catch up with what's happening in hospitals. So that the short story is there's been a V-shaped recovery in the healthcare sector, and our funds have been beneficiaries of that.
Rob, from your beginnings with AMP, back in a more simple time when there were only a few kinds of asset owner, how have you seen the investment markets evolve when you remember that AMP and National Mutual and MLC between them seem to own the stock and property markets?
Well, that's right, James. When I started AMP way back in the mid-80s, AMP was a mutual, so it was a kind of basically non-for-profit for members kind of organisation, and it had a huge investment arm and a big property arm and shares. But it's interesting, if you look at the big pension funds today, the big super funds, they're merging regularly, they're getting bigger, they're becoming almost mega super funds, and they're becoming more and more like mutuals, really, and so almost like, a bit like the AMP of the old days. So it's been a huge transition. I think that merging is going to continue to happen, and we're seeing some of our clients kind of come together as bigger groups. But that's going to present some challenges, I think, and I think it's going to be interesting to observe the Future Fund and also Australian Super and many other large investors, how they handle that size. When you're that big and you're competing on a global stage, and you're investing capital into foreign markets, can you kind of manage those transaction costs? Can you be competitive in those foreign markets when you're deploying such large amounts of money? And so I know the focus has been on administration costs and keeping fund expenses low and fees, but I think there needs to be a strong focus too on deploying that capital efficiently and delivering the returns for members, and so I think that's worth watching.
What sectors or geographies are next for Barwon in terms of new funds and new exposures, or as you said before, have you reached a point where you're knitting and want to stick to it?
Look, we'll be sticking to our knitting mainly, but we will look for adjacencies. So, in those three sectors we're in, so real estate, private debt, healthcare real estate and global private equity, there are other opportunities in around those strategies that we think look really attractive. So don't be surprised if you see Barwon continue to expand, often new products, but they will be kind of allied or complementary to what we're doing at the moment, where we can leverage our existing skills. And I think that's what our investors want from us. They want us to be really good at what we do, be consistent, be transparent, and deliver the returns, and that's what we're seeking to do.
So there won't be a Barwon cryptocurrency fund?
Not while I'm involved.
Rob Morrison from Barwon Investment Partners, thanks very much for your time.
Thanks, James.